Welcome to today's Explainer. I'm absolutely thrilled you're joining me because today we're taking a fascinating look under the hood of India's financial markets. We're going to explore the Nifty 500. Think of it as the ultimate VIP club of the Indian stock market. It's literally the massive engine room that drives a huge portion of the country's wealth creation. If you want to understand how the broader market is truly performing, this is exactly where you start.
All right, let's dive right in. What we have here is the official NSE indexogram for the Nifty 500. Whenever you see this visual branding, you are looking at the heavyweight champion of broad market indicators in India. This isn't just some random list of stocks thrown together. It's a meticulously crafted benchmark that tracks the most significant players in the market, governed by incredibly strict rules and mathematics.
Here is our roadmap for today. First, we'll meet the Nifty 500. Second, we'll cover the rules of entry. Third, we're crunching the numbers. And finally, we'll wrap up with index governance and rebalancing. Part 1. Meet the Nifty 500, the big picture. So at its core, the Nifty 500 represents the top 500 eligible companies on the National Stock Exchange, ranked by full market capitalization. Because it captures such a massive chunk of the Indian corporate sector, it naturally gives us a highly diversified snapshot of the different sector weightings actually driving the economy. We're not just looking at the top 50 giants here. We're getting a much wider, balanced view of the entire market ecosystem.
And honestly, that brilliantly illustrates why this index matters so much outside of academia. Out in the real world, massive financial institutions use the Nifty 500 for benchmarking their fund portfolios, launching large-scale index funds, creating ETFs, and structuring complex financial products. I mean, we're talking about trillions of rupees directly tied to how this specific benchmark performs.
Moving to Part 2, Rules of Entry, the VIP Club. Now, I want you to ponder this for a second. Who actually gets into the Nifty 500? Out of the thousands of companies listed on the stock exchange, what does it genuinely take for a single stock to make the cut? Well, spoiler alert, it's absolutely not a popularity contest. It relies on strict mathematical eligibility criteria. Let's see what's on the bouncer's clipboard, shall we?
First things first, certain financial instruments are just flat out barred at the door. To even get in line, you must be a standard equity share listed on the NSE, convertible stock, bonds, warrants, rights, and any preferred stock that provides a guaranteed fixed return are totally ineligible. Basically, if you're a fixed return asset, the Nifty 500 is just not for you.
Next up, we have the magic number, 800. For a company to even be considered part of the eligible universe, it has to rank within the top 800 based on both its average daily turnover and its average daily full market capitalization. And no, having one good week doesn't cut it. This rank is calculated based on the previous 6 months of data. You've got to prove you're consistently large and heavily traded.
Speaking of being heavily traded, check out this absolute deal breaker of a liquidity rule, 90%. To prove a stock is actively and reliably traded by the public, it actually has to have traded for at least 90% of the days during that previous 6-month window. If a stock just sits dormant on the exchange, it doesn't matter how massive its market cap is, it gets disqualified right then and there.
But what if a company wants to bypass the general consideration pool and guarantee its spot? Well, that's where the fast-track rule comes in, 350. If an eligible security ranks among the top 350 based on its full market capitalization, it is automatically included in the index. If you're one of the 350 absolute biggest and most liquid companies, your VIP table is already waiting for you.
Now, this next one is a really fascinating buffer rule. A security also gets included if its full market capitalization is 1.50 times that of the last or smallest constituent currently sitting in the Nifty 500. It's a pretty brilliant mechanism, really. It ensures that if some rising star explodes in growth and suddenly becomes 50% larger than the smallest guy in the club, they instantly force their way in. It keeps the whole index incredibly dynamic. But hey, no matter how fast a company grows, it still has to prove basic stability. The minimum listing history required to qualify for this index is just 1 month as of the cutoff date. So you don't need to be decades old, but you do need at least 1 solid month of trading history under your belt before the selection committee will even glance at your numbers.
All right, Part 3, crunching the numbers, the calculation.
The Nifty 500 is calculated using the free float market capitalization method. Now, the crucial point here is understanding what free float actually means. It computes the index level by reflecting only the market value of shares that are readily available for trading by the public. It completely ignores locked-in shares, the ones held by promoters, governments, or strategic investors. This guarantees the index is a true, accurate reflection of the investable market that you and I can actually participate in. Consequently, this free float value is what directly dictates each stock's weight and ultimately the overall sector weighting within the index.
Moving to our final section, Part 4, Index Governance and Rebalancing, the Management.
We all know the stock market is constantly shifting, right? So the Nifty 500 obviously cannot remain static. The index is reviewed and rebalanced on a semi-annual basis. The management team looks at the 6 months of average data ending on 2 very specific cutoff dates, January 31st and July 31st. This strict, highly predictable schedule ensures the index gets a regular tune-up without causing chaotic, unpredictable daily swings for investors.
And here is a feature that institutional investors absolutely rely on: total transparency. Whenever changes are made during these semi-annual reviews, like when new stocks are added or old ones get booted out, a 4 weeks prior notice is given to the market before any changes go live. The market is literally never caught off guard. Index fund managers get a full month to adjust their portfolios smoothly. So who is actually enforcing all these strict rules? Well, a professional team manages all NSE indices using a robust 3-tier governance structure to ensure total impartiality and accuracy. At the very top, you have the Board of Directors of NSE Indices Limited. Just below them is the Index Advisory Committee for Equity, which guides the overall methodology. And finally, you have the Index Maintenance Subcommittee handling the day-to-day operational integrity. It's an incredibly structured system, designed from the ground up to protect the benchmark at all costs. Which brings us to the end of our explainer today. I want to leave you with this final thought. When you look at these rigorous, unbending rules, from the 90% liquidity requirement to that 3-tier governance structure ensuring maximum transparency, how does the strict, rule-based governance of the Nifty 500 impact your confidence in broader market investing strategies? Knowing exactly how the engine is built and maintained should completely change how you view the drive. Thanks so much for learning with me today, and I'll see you in the next explainer.